conversation forward in terms of what should investors do and how should they cope up with this fall. Ravi, the question is, 3 months from now, when we will look at May 2022, for those who've sold, will they be happy? Or for those who are putting cash to work, they will be jumping with joy?
Thank you, Nikunj, for having me on the show. I'm not the right person to answer whether it's what's going to happen in 3 months from now. But I can tell you, if we expand the horizon and not look at 3 months, but look at 18, 24 months, then I am sure the investors that are buying right now will be happy. 3 months, nobody can predict, and I don't intend to do that myself. And not like I am predicting that things will be better in 18 to 24 months. I'm just saying the odds are in your favor if you bet at that point of time. See, nobody knows what's going to happen in future. Whether Ukraine-Russia war is going to take an ugly turn, whether there's going to be a nuclear war, how long or sticky the inflation is going to be, or how high the interest rates will go. There is no way to predict that. But what we tend to do is look at whether there are good businesses available at good valuations or no. And what I can say with some confidence is that a lot of good businesses which were unavailable at a good valuations are now coming into the value zone. And when I say now, it doesn't mean it has to be today only. Over the next 4 to 8 weeks, or maybe 12 weeks, if you are to build a portfolio, you'll be happy that you did that over the course of next 18 to 24 months.
The dynamics are changing. For example, impact of increasing interest rates, impact of high inflation. A lot of businesses which were looking like interesting and high growth businesses, the dynamics will suddenly start changing, not in favor of them. How are you reassessing this change in environment? High interest rates, high inflation, high commodity prices, because what looked like a wonderful business may not be such a great business because interest rates and commodity prices have moved higher.
Absolutely right. I think this is definitely a time to reflect on your portfolio, see which are the companies that benefited due to one-time COVID kind of growth bump where the orders got bunched up, or where some amount of extra margin was built in because you had pricing power. And now is the time to stress test whether those companies will be able to hold on to their order books and margins or no. If you find in your portfolio holding on to companies which were beneficiary of a short-term trend, then I think you're better off weaning them out of your portfolio and getting into companies which are likely to be a little bit more secular in their growth. So yeah, it's a time to definitely take a hard look and do a stress test on your portfolio.
Combination of high interest rates and a tightening by central bankers normally coincides with a drop in earnings. It could see economy and earnings moving into a recessionary environment. Now that is the time markets don't do well. And the setting on the table are pretty much reminiscent of a slowdown or a mini recession. So what makes you optimistic that you're getting good businesses at a good price?
So I would disagree with you a little bit over there, that not necessary that rising interest rates lead to a recession. I think in the initial phase of the inflation, or it's more because of what we need to understand is this inflation because of supply dynamics or demand dynamics? If it is because of supply dynamics, and if they are likely to ease soon, then the inflation will come down too. If it is because of demand dynamics, which probably could be the case in US, but not so much in India as of now, then then the inflation is likely to be a little bit more sticky, and one has to be careful. But US market is different. They were at an all-time high margins. They were at an all-time high valuation, and they had a 12-year bull market. So redistribution of the flows from US to other markets can also happen over the course of next few years. See, it is very difficult to say whether it will happen, when it will happen, and whether India will be a beneficiary of that or no. But I think we can make some case that India has a possibility of standing out if there was to be one such redistribution, bond markets to equity markets and from US markets to other markets, then India can stand to benefit. But in the meanwhile, in the short run, for sure, baby is going to be thrown out with the water, and India is going to be bucketed along with all other markets. And this is one place where gains are still there on the stable for most of the investors. So yeah, that is leading to all the selling right now.
So, Ravi, in this market, what is the best way to maximize? Good news and good prices, they rarely come together. Right now, news is bad, terrible, horrible. But have prices become that attractive?
As I said, as I mentioned earlier, they have started entering value zone, but I won't say this is it and go ahead and bet everything you have at this point of time. I think you need to be a little bit more calibrated, hold on to your dry powder a little bit longer. There will come a time, maybe it is usually, bottoms are usually associated with some event. We don't know what that event is going to be. Either it will be ending of a war, or it could be change in stance from the central bankers, or something of that sort will happen over the next 2-3 months, or inflation data starts easing out, and along with that one can have some kind of a sense that okay, finally the worst of this particular phase one of the rise in interest rates is over, and phase one of the correction in this bull market is over for India. I think we'll have to wait for the events to unfold, but valuations will definitely come into a very, very attractive zone if markets were to correct another 7, 8, 10%, and 8, 10% on the index can mean 20, 30% on the stocks easily.
What are your top 3 holdings in terms of a portfolio, or what they were, let's say, at the beginning of the year? What are they now? If you've changed them, why? And if you've not changed them, why not?
Yeah, so I've been saying this since a while that we are bullish on 3-4 themes. Number one thing that we are bullish on is manufacturing in India. I think manufacturing has a long runway. We are going to witness a big manufacturing boom led by the supply chain shift away from China, and also the fact that the corporates in India are getting more confidence to compete with China. So, and there is some amount of protection being given to them as well, and scale being incentivized. So manufacturing is the number one theme. Number two is, of course, the energy transition that we are anticipating, going from fossil fuel towards renewable sources. I think that trend is also likely to stay for a long period of time. Number three is the number three theme that we are bullish on from a longer term point of view, but where some amount of question marks have arisen, is digitization. I think we are unable to say at this point of time what amount of demand that came about in the last 2 years was one-time bump due to COVID, and what amount is likely to sustain. So there are some question marks over there, but because of those question marks, we are going to get some companies at really, really attractive valuations, and maybe that will be the time to load up on them if the trend is likely to sustain over the longer term period. And number four is that I believe there is going to be a cyclical revival in the economy, and that the way to play that is through real estate revival and credit growth in the economy. So those are the 4 broad themes, and we haven't much changed the portfolio except for the fact that we got rid of some chemical stocks which were quoting at very high valuations, and we reduced our dependence on companies that were plays on capital markets and boom in the markets.
Interesting. Ravi, you didn't mention Pharma, or did I miss that?
No, I did not mention Pharma because it's been a while since we went overweight on that. We are currently underweight. We have only less than 10% holding in Pharma, and I do think Pharma is going through some real tough times, and I don't see yet a light at the end of the tunnel because of the recent restarting of the US FDA inspection. Some trouble is coming back, but it's a space where valuations have definitely gotten much more reasonable, and if the growth triggers were to emerge, it will become a fertile ground for us to do some stock picking over there. But currently we are underweight, and we are monitoring the situation.
Interesting. You said a very interesting thing right now, Ravi, that, time has come to do a stress test on your portfolio. Now, stress test for a portfolio is not as simple as, doing a SWOT analysis. Sometimes your strength can turn into weaknesses, and weaknesses can sometimes act as strengths. I wanted to understand, when you do this stress test on your portfolio, What are the key parameters that you're looking out for or judging your portfolio with?
So usually we end up making scenarios on what's going to happen over the next 3 years. And when I say scenarios, it's not like we are building in precise numbers on what's going to happen. But in our assumptions about what the thesis is going to be, we have some assumptions with interest rates. We have some assumptions with raw material scenarios, some assumptions with what kind of growth is likely to pan out. And you downgrade those assumptions and see if those were to pan out, what is the kind of hit on the numbers you are likely to take. And if those numbers are getting hit, what is the valuation that your portfolio can fall to? And will you be able to take that kind of a hit or no? And is there something that is permanently changing in your assumptions or no? So those are the things that we look at and take our call based on that. So not to say that it's a perfect science, but basically go ahead and question your assumptions about the future that is likely to pan out is the simple way to put it.
Ravi, good afternoon. Wanted to also understand what the outlook is when it comes to the kind of acute underperformance that we're witnessing within the broader markets. While, earlier a lot of market experts were advocating to broaden horizons and look for opportunities within the mid and the small caps, now that seems like a far riskier bet to undertake, especially at a time when you're looking at a screen like this. So what's the outlook in terms of allocation? Is there any particular space or sector that you would bet on? Or are you very circumspect when it comes to the mid and the small caps and picking stocks there?
So we have always been market cap agnostic. It doesn't matter whether a company is a small cap or a mid cap or a large cap. Those are things that probably matter to a mutual fund manager because they have to follow the classification as per the SEBI norm. But for us, we are market cap agnostic. So I will look at each opportunity on its own merit. We are a very concentrated portfolio fund manager. So my number of stocks are unlikely to be more than 20-25 across all our strategies. So we take a very, very nuanced view on each and every company that we pick. But the broader themes that we like, I already spelled out when Nikunj asked me. And within those themes, you usually tend to buy either the leader or the challenger. What we don't want to do is go down the quality curve just because the stocks are cheaper over there. We rather stick around with the leader or challenger where we believe the opportunity is still very strong from a long-term point of view, and there is still absolute returns to be made over the next 3 to 5 years.
Fair enough. What about the kind of commodity cycles that we're witnessing in terms of the cyclicality and how you're looking at this entire steel and metal space? What's the take?
So I think the last quarter was one of the best quarter that the metal stocks have seen in terms of EBITDA per ton, and not restricting myself to the steel, but other commodities as well. Whether it is crude had spiked to 130, if you remember, and we are now hovering around 100, 105. So from the peak, all the metals have corrected, and there is a question mark yet. Are we in a super cycle or no? See, these cycles don't usually turn on a dime. There has to be a lot more money made. People have to commit to M&A. People have to leverage their balance sheet, put up huge capacities for there to be an oversupply. See, the demand situation rarely changes. It goes from 4% to 6%. There is not much of a difference, but the supply tends to change dramatically. There is an 8-10 year period where the supply keeps shrinking, things go out of the market, and then again the prices become so attractive that more supply starts coming in. The process of the supply coming into the market has started, but I don't think we have reached a stage where we are in an oversupply situation, and unless the demand falls off the cliff, I think this overall cycle should sustain its upward trajectory.
Ravi, I'm curious to know, at a global level, what are the key data points or macro indicators that you monitor on a daily basis in the current market environment?
So we do try to not look at everything on a daily basis, because what happens is 99% of the times you will get signals that will scare you out of your position. Our job is to ensure that we cut out 99% of the noise and focus only on the relevant data points. So if you are going to monitor everything very, very closely, then sooner or later you will end up convincing yourself that the world is coming to an end and you should be selling your portfolio and getting out of the market. So that is not a scenario for which we build our portfolio. So no doubt every 10 years there's going to be one 40-50% kind of a drawdown. Every 5 years there's going to be 130% kind of a drawdown, and maybe we are in midst of one such drawdown. But history has shown us that over a period of time, if your stock picking is good enough, if you have managed your risk well by ensuring that you're not forced into a situation that you have to sell out your portfolio at absolutely the wrong time at the wrong price, then you will tend to bounce back stronger when the downturn ends. So every market correction is an opportunity in hindsight. What we are trying to do is be a little bit more counter-cyclical over here and try and take advantage of the fluctuations rather than succumb to it. So nobody can time it precisely again, but I would rather be on the side of taking advantage of this downturn rather than getting panicky about seeing prices falling every day.
Sure. Cut the noise. That's the word coming in from Ravi Dharamshi. Ravi, always good speaking with you. Thank you so much for joining.